everything we do here today, we clearly state our objective, and everything we do after today, we clearly state our objective and work towards that objective in sustainable finance. The objective of this panel is to really demonstrate the importance of financial institutions and banks as financial intermediaries in all outcomes of sustainable finance activities, and the importance of markets, as well as to educate on the best approaches and the best ways of doing work for impact. So if I may ask from the back to please come forward and participate in our panel, would really appreciate it. Thank you. All right. Well, let's kick it off. Sarah, let's start with you. RBC has a long history in helping its clients with sustainable finance objectives and sustainability initiatives. And it is supported by your very strong, purpose-driven framework. What, in your opinion and your long experience, you've been at RBC in sustainability in different roles for many years, you're very experienced. In your opinion, what should be the role of banks in funding and transforming and really pushing forward the climate resilience, climate adaptation, and energy transition in our economy? And what are the best approaches based on your experience at RBC?
Sure. Thank you very much, Zlata. Thank you, everyone, for having us today. I think banks absolutely have a very critical role to play in the transition to a low-carbon and resilient economy. But obviously, we cannot do it alone. And I think that is a really important point that sometimes gets overlooked. So to be successful, we need a much broader ecosystem that can create an enabling environment and really drive a pathway to real economy change. So for example, RBC set in 2021 a commitment to achieve zero emissions in our lending activity. But we cannot do that alone. We are reliant on changes in policy, in technology, and in consumer sentiment to drive towards those objectives collectively. So it's an effort that requires multiple stakeholders to be sort of moving in the same direction. That said, I think that we're maybe at a bit of an inflection point or a pivot point as far as bank actions are concerned. We've spent the last several years really focused on the foundations, setting targets, building capacity, increasing transparency and disclosure, and that was really important and fundamental. But now I think in order to get to get to the next phase, if you will, and to really drive meaningful, impactful change, it's time for banks to lean into their strengths, to structure deals, to deploy capital, and to provide advice to clients in support of the transition. Again, we need the sort of the economic conditions to help us do that. Maybe, Zlata, if I can, I'll give a couple of examples of what RBC is doing. That's what I know best. We have a climate strategy. It's called the Climate Blueprint. It describes how we are managing climate-related risk and opportunities. It's anchored around our goal to be the bank of choice in the transition to a low-carbon and resilient economy. And we see sort of two focus areas involved there, or that includes two sort of opportunities or levers. One is engaging and supporting our clients. I think that's where we can have, hands down, the greatest impact. And to do that, we have a climate engagement approach on climate for clients in the energy sector. I spoke to you all here last year about this, so I will not belabor it. But as a refresher, it's essentially a really fulsome approach that guides our engagement with clients in our highest emitting sectors. It includes a transition readiness framework that is a 5-point maturity scale, essentially, that we can use based on the information that clients have disclosed or provided to us directly to locate them on sort of their transition journey. And it gives us really important insights into how we can support them and where the opportunities are to move through that maturity scale from non-committed all the way through to advanced, which would be 1.5 degrees C aligned, and really best in class. So that's sort of one tool that we have. I think then we look at portfolio level actions. We've sort of stood back and said, where can, again, we have the greatest impact? I think one, we can have significant impact by driving or scaling low carbon energy lending. So we've set some commitments to guide us there. We've committed to tripling renewable energy lending and to growing low carbon energy lending, so inclusive of renewable energy, to $35 billion by 2030. And then how can we measure and manage financing and emissions from our highest emitting clients? And so to do that, we've got absolute financed emissions reduction targets in place for the energy sector and interim physical emissions intensity-based targets. So those are sort of the tools that we have. Maybe the innovation here is that we've established a methodology to allow us to sort of track or measure the progress of those two metrics over time and their relationship with each other. And that is with an energy supply ratio. So this ratio allows us to see how those two things are changing over time, how we're growing low carbon energy lending faster than lending to higher emitting sectors. And that is the case. So we've been tracking this over time. These metrics are reported monthly and quarterly to the most senior levels internally. We haven't disclosed the ratio externally for Competition Act-related purposes, which we can talk or not talk about, but we have disclosed the full methodology, and so you can put it all together as you wish. But I think this is a really important tool, and again, a more sort of impactful one that we have for supporting our clients in the transition. I'll maybe pause there, Zlata, and
and I was just going to comment, a lot of these frameworks you've put in public domain. I just read your climate blueprint, which is incredible. Everything, every detail is in public domain, which is really impressive. John, do you have anything to add on the role of the banks and kind of best approaches?
Sure. Thank you, Zlata. And thanks for having me here. I will, before I start, call out the fact that Gary mentioned his fireside chat with Wendy Berman. He renamed the future of trust. And it's kind of awkward because we don't have the future of trust for RBC and BMO, but let's see if we can convince you otherwise. So I think in terms of the role that banks play in financing a low-carbon economy, it's really unique, right? So if I think about institutional investors, for example, they're critically important, but they are managing existing assets, existing investments after they make that capital allocation. For banks, we're really at the ground level as it relates to allocating capital and providing financing to companies that either are going to decarbonize the economy, be neutral, or the opposite of decarbonize the economy, make it very carbon intensive. And so I think with that role requires us to be very deliberate and very thoughtful. And Sarah and RBC outlined a little bit of what they have in the public domain around the way that they're being accountable for their lending practices. We similarly have a number of these same commitments, some of which we disclose, others we will soon. But I think for us, a big focus is on the types of clients that we're providing this financing to in the form of underwriting or lending. And so for us, this year we're the top underwriter of sustainable bonds for CAD dollar SSAs. We provided some unique and bespoke financing to a company called Chestnut Carbon that provides carbon removal. They're a carbon removal project developer. And really, we got comfortable with the credit on the back of the fact that there was a 25-year offtake that they signed with Microsoft. So we, applied sort of our normal credit filter to a borrower like that. But it's a way that we're showing we're really committed to the carbon removal space in particular. I think another big area, and I'm sure we'll touch on it with other comments as well, is just around resiliency and adaptation, right? As we think about where money needs to flow now to avoid the worst impacts of climate change, a lot of that we're moving past mitigation. Mitigation is still critically important, but into themes of building resiliency, both for the public sector, right, as we think about municipalities and provinces, but right through to the private sector as well, as we think of hospitals and pharma, as we think of ag and manufacturing, certain sectors that are impacted and outsized impacted by some of the climate risks that we see today. I think those sectors that can't fail, they can't have supply chain disruptions because in many cases it's life and death at stake. I think we're really zeroing in on those types of sectors and focusing on where we can play a part as a bank in allocating capital on the ground floor in a way that creates very resilient and adaptive outcomes.
Thank you. And maybe, John, you could follow up on some other innovation type of initiatives, like what opportunities you're seeing for growth and innovation for banks in addition to what you already mentioned in terms of the role.
Sure. Well, what I will say is for the investors in the room, you're all getting really, really sharp and really smart around where your investment dollars are going and the impact specifically of your investments. And that's a good problem to have, right? The rising water lifts all boats. I think as we think about the opportunities for growth and innovation, one good example, and albeit not climate, but topical for us at BMO, was just last month we issued a $200 million labeled Indigenous bond, where we used the bond proceeds to support Indigenous communities and Indigenous-owned businesses in Canada. In doing so, we became the first North American bank to offer a labeled Indigenous bond. And really what we did there was it was on the back of reverse inquiries that we had received from investors who were calling for more thematic investment opportunities, and particularly to support Indigenous communities. Through that execution, we saw a number of investors show up. It was oversubscribed significantly. We saw some pricing benefit as well. But I think the bigger impact that we saw from that $200 million issuance was really just bringing some attention and clarity around the need for Indigenous financing to flow directly to these communities. We're going to see more and more around Indigenous equity participation through large infra build and projects in Canada. We already see a lot with Indigenous loan guarantees and other arrangements and structures that are in place and announced. I think as we think about what we, again, as a bank need to be doing in the sustainable finance space, it's going to be critically important to ensure that money is flowing to Indigenous groups that can be very relevant around the table as we look at some of these infra projects. I think as well, affordable housing for me is one that we spend a lot of time thinking about. BMO, we committed to $12 billion in affordable and accessible housing financing by 2030. I was at an event last week with a charity called Partners for Affordable Housing. They've stood up a fund with both private and public as well as philanthropic capital that's flowing into it that's really looking to solve some of the funding gaps that we see for affordable housing. And it's not as much a social issue, it's an economic issue. It's an imperative that we get affordable housing right in Canada, but also do it in a sustainable and resilient way as we're building these new homes and retrofitting. I think biodiversity bonds and natural capital financing, another innovative area in sustainable finance. So again, as we hear investors call for more thematic bond issuances, particularly on the back of COP30 just 2 weeks ago, we're seeing the Amazon bond, the Amazonia bond, the Amazon fund. We're seeing some different announcements come out of ways in which the private sector as well as development banks are really prioritizing investment and nature in a way that will be long term. And then finally, we think about the climate resilience bonds, which I mentioned earlier. We saw the city of Tokyo issue a 300 million euro climate resilience bond last month. And use the bond proceeds to build up, some of the seawalls and whatnot around Tokyo. I think that theme, again, private and public sector, I think that will be coming to Canada in the near term. There's a lot of spend, particularly, yes, around flooding and around the fact that we border 3 oceans, but certainly around wildfire relief as well. That's a huge portion of a lot of provinces' spend these days, and so we're hearing from investors, and that's kind of the starting point that. There's a lot of interest in supporting these types of projects that, again, are building out resilience in Canada.
Yeah, congratulations on the Indigenous bond. By the way, I watched that in interest, in particular from the perspective of how you used your data capabilities, ingesting the data across Canada for the Indigenous bond purposes was not easy, but congratulations. And also it's great to see the private-public partnerships finally taking reality in it. Sarah, anything to add on new financial instruments or structures?
Well, I think that was a really comprehensive list that John provided. Maybe just on the public-private partnerships piece, I would add blended finance as another opportunity. Before I do, though, I would just double down on the importance of Indigenous economic reconciliation, the opportunity there. And so we know that the sustainable debt market in particular is very precedent-driven. So BMO, thank you for sort of hopefully starting or catalyzing what might lead to more sort of labeled or focused bonds for Indigenous-related use of proceeds. And there's work being done across the industry to support that. So good news. Blended finance, I think that this has been around forever. We call it blended finance now. An example I'll share, because I think there are some meaningful ones in Canada, is with the Canada Growth Fund and the Building Ontario Fund. So just a couple weeks ago, it was announced that RBC had acted as the exclusive financial advisor to both of those entities, Canada Growth Fund, Building Ontario Fund, in their $2 billion and $1 billion, respectively, equity investments in the Darlington new nuclear project. So this is a project that will be owned, or is majority owned, that is. Now these CGF and BOF have minority stakes, but majority owned and operated by Ontario Power Generation, or OPG, and a first of its kind. So 4 small modular reactors will be built, grid scale, over a period of years, huge cost, huge risk. And so first of a kind, high risk projects like this really struggle to attract private capital. And the role, therefore, that the CGF and BOF can play by coming in is to help de-risk those projects and to attract that private sector capital that will be needed to support projects like that going forward. So really excited to see things like this developing in the market. That project was one of the first 6 nation-building projects that Mark Carney referred to the Major Projects Office. So hopefully more to come and a bigger role for the Canada Growth Fund to play going forward.
Thank you. So most of these financial instruments wouldn't see the light of day if there were no markets participating in investing in them. And so, Olivia, you have the first row view to what investors are thinking. How are investors thinking about energy transition plans that financial institutions are putting out there on behalf of their issuers?
Absolutely, and thanks, Lada. I think the first step investors are increasingly taking is to embrace the nuance of risk management versus climate impact. And so you have to ask yourself what your mandate is. Is it primarily the financial risk, or can you also go one step further with climate? And so these are kind of 2 sides of the same coin. So when you're looking at risk, transition plans should be preparing companies for a future where supply and demand can look radically different. Whereas on the climate side, you should be asking whether transition plans ensure that companies will remain within the carbon budget when you look at their whole life cycle emissions. And so what does this actually look like? If you're looking at energy demand, so sectors like steel, transport, buildings, investors are really starting to drill into the capital that's needed. The transition is going to require a lot of capital for these sectors. And so identifying whether there's a credible source of capital and a sufficient source within the transition plans is critical. Now, Zlata mentioned I'm an oil and gas analyst, so I look a lot at that sector in particular. And really the question boils down to how is the company planning for a future of declining demand in oil and gas? And this matters not just from a climate perspective, but also risk, of course. So as you have declining demand, you also have falling commodity prices and ergo financial risk. And so just a bit of context, we've heard in previous panels about the plummeting prices of renewables, and that is really the pressure point for oil and gas. And if we're looking at electric vehicles, for example, just 5 years ago, they comprised 5% of new car sales. Today, that's over 20%. By 2030, it's expected to be over 40%. So this is a global outlook, and it's not something that just one country can reverse. And so it's this context that matters for transition plans. Investors are moving beyond emissions targets, which are a necessary first step, but you need to also be looking at production and CapEx plans for new projects, what commodity prices companies are planning around for their future revenues, testing the sensitivity of their cash flows to different scenarios, different commodity price scenarios in the long term, and making sure that incentive systems are aligned with these at the top executive levels. So just wanted to pick on the last two threads, which are the scenario analysis and incentives, because these are relevant not just for companies, but also for investors as they're actioning on these transition plans. So if we think about scenario analysis, you may have seen analysis of cash flows to different commodity prices in the future at the company level. But then among investors, they really need to be looking at the portfolio level. So let's say you've assessed an investment to provide a return of X%. That's great, but you also have to look at whether that investment is contributing to climate change, which could negatively reduce the portfolio level returns. And so the real return of that investment might not be X%. So it's this kind of macro level, long-term approach that's increasingly relevant. And then from the incentive perspective, of course, long-term incentives are important to increasingly incorporate among companies. But investors also need to weigh up the short-term cost of the transition with the long-term needs to maintain relevance in an economy that's transitioned. So those are just some of the big questions that we've seen investors continuing to grapple with.
Olivia, I know you have a lot of experience globally, and you come to us from London, UK today, by way of San Francisco. Do you have any experience in Canada? I believe you did mention you have one Canadian example you can contextualize for us.
Yeah, absolutely, and very happy to be in Canada for this. We've recently conducted an analysis of the 10 largest Canadian oil and gas companies and wanted a kind of a global picture as well. You mentioned, or someone mentioned, Canadians love to compare themselves to the global context. And so, yeah.
I think it was Gary.
And so we looked at the resilience of cash flows from new oil and gas projects to a range of commodity price scenarios rooted in the reality of the energy transition. And we found that the Canadian sector faces particular downside risk compared to peers, where business as usual investments would erode portfolio value of producing assets by up to 30% under a fast-paced transition. And the upside is only 10% under a slow transition. So it's that 3-to-1 risk reward that's particularly concerning for investors. And it's not just investors, it's also, if you look at the exposure of the banking sector here, it's highly exposed to fossil fuels, and this has broader knock-on effects for the economy at large, of course.
Thank you. Yeah, Sarah and John, you both work with clients a lot. That's your primary role, is client-facing advice. What themes are evolving from your perspective for Canadian issuers and investors? How is the market evolving?
Maybe I'll go first, John, and then invite you to chime in. And Olivia, you might have some perspectives on this as well. We've talked about some of the themes. First, maybe I would just make a few comments about the sustainable finance market, which is where we spend a lot of time. I think that in Canada, this market has really matured. We've seen sort of top-line issuance volumes remain resilient, but there are some interesting nuances beneath the surface. So we've seen a real slowdown in issuance, I guess, from new issuers and new corporate issuers in particular. And instead, we're seeing a lot of repeat issuances from large existing issuers. And I think that's just a sign of maturity and sort of depth or lack thereof in the Canadian context. But there are ways, I think, that we can encourage new issuers still to come to market. They've faced some significant headwinds, all the macro and geopolitical ones that we're familiar with, but equally some legal and reputational ones here in Canada from things like greenwashing scrutiny and so on. And so hopefully some of these dynamics will shift over time, and we'll get back to a place where issuers are more comfortable and where they're well incentivized through things like greeniums or price benefits from issuing. So maybe those are some high-level observations on the sustainable finance market. A couple of themes that I think are really trending or resonating right now that we haven't sort of dug into in significant depth. One is the energy transition. So we've talked about that, but I just think it's really important to acknowledge that the frame around climate mitigation has really changed. And we are now thinking about climate in the context of energy security, of geopolitical risk, and of economic growth. And I think that is really interesting, but also potentially really powerful and really pragmatic. This sort of nexus of security, if you will, issues is important. And I think what we're observing on the ground, regardless of labeled issuance, is an irreversible momentum around the energy transition in the rest of the world, outside of the US primarily, but even at the subnational and local level in the US, there is, make no mistake, a lot of action being taken. So I think that's interesting. We just saw the International Capital Markets Association publish climate transition bond guidelines. So for the first time, finally, they have acknowledged that we can have labeled transition bonds. I think there was some resistance to creating another label, but hopefully this will help. And we also saw the Canadian federal budget sort of really playing with these themes around climate competitiveness and economic competitiveness. A couple other themes just really quickly. Climate adaptation resilience, John talked about that. I think as the physical impacts of climate change escalate, we are seeing some really interesting investment opportunities into adaptation-related solutions. And so I think that's a space to watch carefully. And then defense. We talked about security. I think particularly for our colleagues in Europe, but equally in Canada, I think we're seeing a really interesting shift in attitude is not the right word, but a changing case, let's just say, for investment in defense from sustainable investors. And I think we know sort of the history here. Many sustainable funds have had defense sector exclusions for many years and for a variety of different reasons. But in today's context, in a situation where investment needs to increase substantially and where arguments are being made for the human right to security, I think some investors are starting to rethink some of those exclusions, or at least think about how these two sort of concepts can correlate. And so we're watching that very closely as well.
Yeah, it's kind of like an extension, the defense comment that Sarah's just making. It's almost like where nuclear was a few years ago and is now for most investors, not all investors, but many who had it excluded from their portfolios for a period of time are either walking that back or very bullish on it. I think, obviously you can get downtrodden if you just read CNN every day. You might expect that the war on climate is real, but it's interesting when you get out into the real world, and particularly outside of North America, where you're seeing renewables scaled at levels we haven't seen before in Europe. And China's obviously a leader in solar and storage and batteries. And even here in Canada, right, we have sustainable investment guidelines that we will see by next fall, a transition taxonomy in Canada, and 10 billion in transition labeled bonds starting in 2027. So there is a lot of momentum in this space, but we are seeing a form of climate pragmatism, I suppose. I've heard a few times where it is still very much a view, or it's becoming increasingly a view of, where do you drive the most value from the climate or sustainability commitments and actions that you're taking as an organization. I think we're almost in a sustainable finance 2.0 scenario now where it's not simply about assessing optimal and efficient ways to allocate capital, but it's doing it with a lens around impact, and not just sustainability impact, but financial impact, right? And so we've heard about opportunities and risks for years and years around investments and trying to assess the upside on the opportunity side. There is a bit more focus on risk management right now, but in a way, the businesses probably should have always been approaching it around making the capital allocations towards sustainable outcomes. And then the only other comment I would make is around, we heard on the previous panel with Wendy around, it's not a lack of data that exists in the market, but the quality and credibility of that data is still what investors need and aren't necessarily seeing and seeking. And we see that borne out in the labeled green bond market a little bit, where you have, I think, 70% of allocations under labeled green bonds globally, and same in North America, go to one of four categories: clean transportation, energy efficiency, renewable energy, or green buildings. I think investors are calling for more credible data, both in those four categories, but also across the other themes like climate resilience, adaptation, biodiversity, et cetera, that we're seeing now. And so I think as the quality of the data improves, we'll continue to see the flywheel spin in sustainable finance, and we'll move into the next generation.
Thank you. Yeah, to your point on new themes like defense. I think it was Michael Torrance who quoted someone else from Climate Week this morning on ESG is now taking on a new meaning, and that is energy security and geopolitics. And that is indeed the summary of the new themes. Interesting. Well, thank you so much to the panel. Really appreciate you joining us today, and really appreciate you were a wonderful audience. Voila.
Yeah, thank you so much.